Let's start with the big ones, the big hyperscalers. We're talking Amazon, Microsoft, and Google. You just actually put out a new note today with new ratings and new price targets. What's your top pick in the group?
Yeah, so Frank, next week we have Alphabet, Amazon, Microsoft, all with their September quarter results. Our top pick is Alphabet, and it remains so. These stocks have all done well this year. Microsoft up 35%, Amazon 50%, Alphabet 55%. Alphabet's the one where valuation's still quite reasonable. You're trading on about 18 times PE for 2024 ex cash.
Okay.
And so that's still our top pick out of those top three hyperscalers.
And what's the price target? Alphabet trading right now at about $137.
Yeah, our price target's $163.
So you see considerable more upside over the next 12 months. What's the catalyst for that? So one thing about these three companies, they're leaders when it comes to cloud computing globally. Taking a look, AWS, Amazon has about 36%, Microsoft with Azure about 22%, Google Cloud just about 12% of the share when it comes to the public cloud right now. What's the catalyst specifically for Google to move higher?
Yeah, so for Google, there's a couple of things. First of all, the results next week. So we are 2% ahead of consensus on revenues. For the Q3 results. That really is driven by three things. One is the core advertising business. We expect a 1% beat. Search continues to take share, we think. Secondly, that other business, which we don't talk about as much, but YouTube Premium, YouTube TV.
Oh, just that.
We had some price increases coming through there. And so that's going to help the quarter. So we think actually they could beat by almost 10% on that. You also have, of course, 1 month of the Sunday Ticket. And then third is Google Cloud, as you mentioned, which is the enterprise cloud computing business. Again, we expect a 2% beat there. We're 4 to 7% ahead of consensus the next few years on Google Cloud. And importantly, we see them winning share there against AWS and Microsoft Azure as AI becomes a more important driver.
You almost buried the lead there. All right, I want to look ahead to the rest of earnings season. Of course, we have Netflix reporting later this week. Netflix, mega cap tech stock, not really influenced by AI, but also pretty volatile. Moves a lot on earnings. What are you expecting from Netflix? And do you see it having a big influence on the rest of the tech sector?
Yeah, I mean, I don't cover Netflix personally. I focus on the other software names. But I think overall for big tech earnings, I think numbers will be good. We continue to see demand as stable. It's not improving. It's not deteriorating. But I'm not sure if they'll be good enough. And what I mean by that is Q4 is all going to be about 2024. So that's what investors are starting to look at, is what's going to happen next year. So even though we think Q3 results will be okay, we think companies will still sort of hedge their bets a little bit about next year because of the uncertain macro. So we may not get that confidence about next year that investors may be looking for just yet.
All right, I want to talk to you about next year. A lot of concerns about a possible recession. Again, they went away and now they've come back. Give us a sense. This year, we've actually seen tech companies spending more. When we started the year, it was supposed to be like a year of efficiency. Is that over? What are investors focused on? Are they focused on AI-centered growth, or are they focused on efficiency?
Yeah, I mean, you're absolutely right. So Q1 was all about the year of efficiency. Q2 was all about Gen AI. Q3 was a bit of a digestion because those Q1, Q2 drivers obviously drove these stocks to quite to high levels of the year. And so Q4, like I said, is going to be about 2024 and that outlook. Some companies like NVIDIA, like Microsoft with 365 Copilot becoming available on November 1st, are obvious early beneficiaries. But what the market's trying to figure out with Gen AI is who's going to be next and how long is it going to be before we get those returns on those investments that are being made.
All right, so you just mentioned you cover a pretty broad universe of tech stocks. We were showing some of them. You've been at a lot of different conferences for Salesforce, for Adobe, et cetera. Here's a question that I don't know if they're going to answer in those conferences, but I want to ask you. We're in a higher for longer environment. A lot of concerns about the 10-year possibly hitting 5%. Which one of these mega cap tech names is the most vulnerable to those higher rates?
I mean, one of the names that we've turned a bit more cautious on is Microsoft. We downgraded to neutral a few months ago. I travel across the U.S., across Europe, across the Middle East, talking to large institutional investors, and it remains the #1 position in a lot of investors' portfolios, sometimes close to 10%. And so with the investments Microsoft making, you only have about a 2.5%, maybe 3% free cash flow yield right now. Now, that's a bit depressed, because you have high CapEx, and you're not quite yet getting the returns from those investments. But for sort of global investors who have other options, they're looking at that 2-year at 5% and saying, do I want that, or do I want Microsoft with a 2.5% free cash flow yield?